All right. When are those rates going down, Ken?
Tomorrow. Nah, it's always
Yes.
tomorrow. It's always tomorrow, though. When we get to tomorrow, it'll be tomorrow. God,
All
that's
right.
$1 million question right now, isn't it?
It is. It is causing extreme discomfort for many in the housing industry. I get it, not for everybody outside of housing, but appraisers, title folks, attorneys, real estate agents, loan officers. Yes, major. There's just nothing happening on a unit basis. Not a lot of units being turned. So, okay. CPI comes out today. Core is up 0.6, higher than expectation. We saw the 10-year treasury bounce up above 4%. Don't know where it's at the moment. 7.20 is the average daily rate for 30-year money. Again, these are 20+ year highs right now. So let's talk about what we think is.
It's a flashback, isn't it, to shortly after we got started in the business, or when we did get started in the business, where rates are. I hear people say that a lot, right? Some older folks are saying, we just need to have perspective. These rates aren't that bad. Historically, we've seen this before. It's not the end of the world. All of that totally makes sense. It's
turning my beard gray.
It's just that pace of change in a short period of time that has really been frustrating or disruptive to the housing market.
Totally fair. When I looked at Freddie Mac's out today, it said the week over week was like 6.9 something, highest in 20 years since 2002. But what's most noticeable about that is, let me see if I can find this here, is up 3.87 year over year. I'm going to share this on the screen here if I can do that. Where is my share screen button? Share screen. Okay. This right here is what's just crazy.
Yes, that's what we're feeling. Every single person that I talk to, when we're talking to them about getting started, that there's a surprise, and that change has such an impact on affordability. You know, we've got some folks that now need to be looking $20,000 to $50,000 less expensive of home price range because of that pace, that change just in the last couple of months. And again, that you could, one school says, hey man, that is what it is, you know, deal with it.
I was just talking to a real estate agent before we got on the call, and she had said when she bought her house 20 years ago, she believes it was like 7.5%, 8%. So what'd you pay for it? She's like, 200 grand. I said, what, that 200 grand house is now 800 grand. So 7% at 200 versus 7% at 800, big difference, obviously. But that the extreme volatility along the way of going up 4 percentage points over the year as well, where we've had swings up to 6.25, down to 4.99, back to 7, back to 6, 7.2 is where we're at today. But let's talk about the inflationary numbers, which is really going to help folks understand when these rates are going to be driven back down, what we think is going to happen. If you want to bust up that chart on the screen here.
Yeah, this is intended to be helpful, but maybe more confusing. What this does is it just kind of shows how that big number, the 8.2 or 3% number that you hear in the news, how it's calculated. So what they do is they take the monthly number over the last 12 months, add it together, and that gives us that inflation number. So the good news is that there were really low numbers that were factoring into that report, even as early as the one today. So next month's inflationary report, those three small numbers that you see in yellow, they're going to be in the distance. And now we're going to be talking about higher numbers for the last 12 months. So as these steps that the Fed is doing to try and curb inflation, if we have a little bit of movement improvement there where inflation comes down on a monthly basis, and we're averaging bigger numbers from in the past, inflation, it's probable that inflationary numbers are going to start to ease next month when we get this same report that we just got today. So that's the encouraging news.
So mortgage rates work in anticipation of what they believe the market is going to be doing. They're not waiting for data to come out. So for example, when the CPI comes out again in November, a month from now, we're more worried about, or we're more concerned about the Fed and what they're going to do in the November meeting. So these numbers say the Fed's going to cut another 3/4 of a point,
Increase.
or raise,
Yep.
hike 3/4 of a point. I wish they would hike or cut right now. But November, December CPI reports are going to be crucial to what we think mortgage rates are going to do. And like you just described, that core number, as it moves down and over a 12-month period, it won't look and it won't feel as bad. Meaning we're not going to see the prices of goods go up from this point. We're not going to see groceries go up to another level, gas go up to another level, rent go up to another level. That's all been contained in the fact that these rates are so high right now, and it's
So
cooling the demand.
That rent piece is critical, right? That's a big percentage of that calculation, each number. And what we're seeing are that there aren't as many homes going to the market to sell, but there are a lot more homes going to the market for lease or for rental. If we kind of follow that through, as more properties go on the market for the rental side, that should start to reduce gradually what landlords are able to charge. So hopefully that component moving forward is going to help that inflationary number as well. And you're right, God willing, groceries, all of that stuff will stay modest or mild increases, if any, moving forward. So fingers crossed, right, that the worst is behind us.
This could be the bottom right here. This could be the worst of it, potentially. Again, we don't know that for sure. But the odds are in favor of that November CPI report showing. Go back to that chart real quick if
Sure.
you can find that, and then we'll explain to some folks. So if you look at September of 21 at 0.3 versus September of 22 at 0.6, the year over year shows inflation increasing, correct?
Yes.
All right. So if October comes in at, let's say it's 0.4, 0.3, and then you go back a year to 0.6, it's going to show inflation is starting to cool. That means the Fed believes that it's doing its job. And if the market sees that, we're going to see mortgage rates start to cool a little bit from where they're at right now.
Well said.
Where they're at right now is we're not getting a lot of activity on homes that are being listed because there's just not enough people that can afford to qualify to buy that house for the people that are in the market. A lot of people are just not in the market right now. I'm just going to take a powder, take a break.
You and I view that similarly, but slightly different, right? Your perspective is affordability, just that. And I agree, that's a component, but the part that disturbs me is that this volatility, it just says to people, I'm just going to wait. It's too much chaos. when we go your example, right, 4.99 to 6.25 to 5.5 to 7, that is too chaotic for a healthy real estate market because it's too much the tax it puts on a potential buyer to navigate all of those things in the chaos. It's just too much. People raise
Guys,
the white flag.
Ken's right on that, right at boots on the ground level, talking to the consumers, helping them navigate their pre-approval. And what he is saying is absolutely true. I don't believe a lot of people in the industry outside of the mortgage loan originator on the front line understand what he just said of the tax it takes is on them. It's just exhausting to know I got pre-approved at 5 and here I am 2 weeks later and it's 6. It just crushes their spirit. From an affordability standpoint, Ken understands what I'm saying. From an emotional standpoint, I don't think a lot of people understand it.
No, it's unbelievable the impact that has. It's like watching a balloon deflate. That's what I'm seeing in my mind when I'm chatting with people, and you start talking about that. And then the follow-up calls of people we've been talking to for months. I'm like, hey, this is, I just want to eliminate any surprises. I'm not trying to be bad news Charlie, but hey, if you're still looking, make sure that let's connect and give you an idea, because it's a substantial change. You're $200 to $300 difference in payment just in the last 45 days. And that's hard.
I'm gonna share the screen again to help reiterate what you just described. Okay, so this is 1 year. So even we'll start here, December of 21, everyone that goes to get pre-approved and they start looking for their home, it just keeps going up and up and up on them. And it slowly starts to wear them down. Does it not? That's what you're saying. It
totally does. Yes. If rates are steady, a home buyer can take into account the increase in price.
All right, look at this. We're going to back out 5 years. We're going to back out 10 years. This is where we're at right now. We haven't seen anything like that. The peak before that was 18. It was under 5%. I mean, that is very, very difficult for folks to get their arms around, not to mention, let's use $400,000 purchase price on a house. I'd much rather spend $2,300 on rent than cough up 80 grand and have a mortgage payment higher than the rent payment.
Well, especially when you factor in there, what are home prices going to do? What are interest rates going to do? So there's not a clear path for people to get an understanding where you're like, well, if I buy now, I mean, what if home values go down a little bit? Now, historically, that's not a big deal. But when you take that with abnormally high interest rates, it just gives everybody a reason to go push away from the table for a little bit and say, I'm just going to let this settle emotionally for themselves as well as the market.
All right. So where do we think mortgage rates can get? What will happen to them as we move into that December month? Look, October is baked in the cake. We're going to get into November. Turkey Day's coming. But let's say by the end of the year, can we see interest rates back to 5%, mortgage rates?
I don't think we can see them get to that spot by the end of the year, but I think by the middle of next year, that is very, very possible. So, once rates start to drop, it's going to be a frenzy because lenders are broke. So as soon as rates go down, lenders are going to be frothing to try and get as many refis in the door or help these people purchase. So we've got some volatile supply and demand issues that we may have to mitigate. But typically rates go up fast and they settle slow. So there's going to need to be some certainty in the economic numbers, a little bit more than just one reading or two. We're going to have a little bit of a history of inflation truly being in check before the markets will settle down. And then investors will think
bummer,
that
I
buying
lost you.
mortgages is going to be a safer option than the concern about inflation again. So I think it's going to be middle of next year until we get to that sweet spot.
There you are. Sorry, I lost you for a second on my end. Looks like I got an unstable connection. So let's try to wrap up here. So somewhere in that 5 to 5.5 range, that might be possible as we enter into January, February, March.
Yeah, I would say
That's huge.
spring.
That's 2 points, almost 2 points lower than where we are right now. And there's nothing happening where we're at right now. So more time will go by. Sounds like a plan to me.
It is, on the purchase side, it's needed to get demand and people confident and comfortable again. On the refi side, we know with this inflation, consumers have had to have increased their consumer debt balances. And if you have a home, the equity that you have accumulated in the last 3 years is massive, right? That there's a big chunk of equity that you've gained. And if those rates come back down, that's going to provide an opportunity for people to not pay 18 to 20% on credit cards. So we're excited on both sides, right? We want to
Or
see the home
10% on
market.
HELOCs.
Yes.
8,
So
9,
that
10%
part-
on HELOCs, 18, 19, 20% on credit cards. Wicked. We'll get into that in a later discussion down the road, but that great point, that's coming too.
So hopefully now we start to get talking about more good news as this stuff continues to, we're at the top of the mountain, hopefully, and things will continue to improve. And again, get people's excitement back out and remove some of the apprehension.
I love it. Thanks for the info.
Ditto.
Have a great day, great weekend. Talk soon.
See you guys.
Bye.